Hey everyone, happy Thursday, June 8th. It's about 10:30 on the West Coast, and it's time for another market updates. The debt ceiling drama is behind us. That's great news. That was causing a lot of volatility, so we're done with that, thankfully. Going back to last week, though, we did get a big May BLS jobs report. And that number came in really high, plus 339,000 jobs, but unemployment rate was up. So the expectation was 190,000 jobs added, and 339,000 were added. So big jump. And they also revised the last 2 months up by 93,000. So that's big jump, big headline number. That's bad. Keep in mind the business establishment survey. This is a bigger sample size, but it's also done with a lot of different math and forecasting, where the household survey is where they actually call people. The weird thing about this business establishment survey part is the birth-death ratio, which tracks the number of employees, the net gain or loss based on new businesses opening or old businesses closing, was plus 231,000 jobs. So that basically means that over the last month in May, they said there was 231,000 jobs created based on new businesses opening above and beyond any businesses that closed, which doesn't make a lot of sense. That's a weird number given the current economic environment. And then going into household survey, this is actually kind of came across a little better for us. Unemployment jumped from 3.4 to 3.7. They showed a job of negative 310,000 jobs lost. So the markets really reacted to this headline number that they throw out there, this 339. But throughout the day, it kind of modified a little bit, but still, this wasn't a good BLS jobs report for us. We wanted to see a lot less number than that. Like we've talked about, not that we want people to lose their jobs, but we definitely want the Fed to back off and to see that there is some weakening in the job market. So the next thing we got, CoreLogic and Black Knight both came out with April appreciation, and they're both up to kind of continue the trend. So I showed this one last week, but now let's update it with these two new data numbers. As you can see, Case-Shiller, FHFA, CoreLogic, Black Knight, and Zillow all are continuing to show home prices turning higher as we go closer. And again, this is on the national level, or as we go along. Far cry from a crash. It looks like home prices are recovering. And so if you were someone that stood on the sidelines and said, hey, I want to wait for home prices to come down, that does not look like it's happening, unfortunately, for you. The next thing, we got more recession indicators, both the ISM and from trucking. So first we got an ISM is non-manufacturing data. So it's at 50.3 right now, is what this number is at right now. Under 50 is considered contraction. So it's barely hanging on. And this was actually the lowest number in 3 years. So it's coming down. We're seeing some contraction. So that's an indicator that, hey, we're starting to see some weakness in the economy, on top of what we've already seen. And then on top of that, trucking, it was the Evercore trucking survey. For that one, the recession shows if that reading comes in below 48, then it's considered recession. Right now, that number came in at 36. So really low, really strong recession indicator. Next thing, this week we got initial job claims. So this came out today. This actually worked in our favor. The last couple of days, some negative things happened and affected rates, but today this initial claim, it was expected to be about 235,000 initial claims, and it came out at 261,000. So again, not good to see people lose their jobs, but if the Fed's paying really close attention to this, then this was in our favor. This worked in our favor. Continuing claims came down slightly, but they're still at really high levels. And even when continuing claims, come down a little bit, that could be, maybe people found jobs, but that also could mean people just ran out of benefits because they've been on benefits so long. So again, not good to see people lose their jobs, but it is a point of data that the Fed is going to be looking at here with their meeting coming up next week to show some weakness in the job sector, and hopefully, they back off. Purchase apps, negative 2% last week, negative 29% year over year. Once rates come down, purchase apps will go up, and once inventory goes up as well, and those are still at really low levels. Some miscellaneous stuff. So a couple different things. So OPEC plus the oil production, Saudi Arabia announced that they're going to be cutting 1 million barrels a day in their production from 10 to 9. So the reason we don't like that is that's inflationary. If they're not producing as much oil, then that could drive up the price of oil, and that will drive up gas prices. That's inflationary. We do not want to pay more at the pump. And then we also got the Reserve Bank of Australia and the Bank of Canada. Both this week did surprise rate hikes. The Bank of Canada, especially yesterday, that was a surprise one, and that hurt the markets. The markets did not react good to that, especially with our own Fed, on the horizon, making their own decision here in a couple days or less than a week at this point. And then used cars, Manheim used car serve index for May came at negative 2.7%. The reasons that's important is we have inflation data coming up. We know that the last inflation report showed a big jump in used cars. So every indicator that we've seen since then shows used cars coming back down. So that is hopefully a positive thing to look forward to with our CPI data coming up next week, to hopefully that we don't get that huge jump in used cars like they did with the last report. So where does that leave us? Average conventional crept up to 6.90, stayed below that 7.0 mark. It actually dropped down a little bit today, about 0.05, but still way higher than we want. We need to make some progress there. So important dates. We got CPI coming up on June 13th, and we got the Fed next Wednesday. They have a 2-day meeting, Tuesday and Wednesday. They will make their Fed decision on Wednesday, if they're going to hike or not hike. Right now, we're at about 70% chance. The markets are saying that they won't hike, and a 30% chance that they will. Like I said, the CPI data, we know that oil prices were lower in the month that they're going to be tracking. We know that used cars seem to be lower. Those were 2 big jumps. We expect more positive momentum on the shelter sector, where shelter was creating a big jump in the report each month. That should be kicking in more. So we're optimistic that CPI should come in lower. That would be great for us. The problem is Fed the very next day is their rate hike, so they don't have a lot of time to make their decision. So we really need that data to come in positive, and hopefully, if they haven't decided to pause already, that pushes in the right direction. If they decide to pause, that should be great for mortgage bonds. That should be good for mortgage rates. If they decide to hike again, that would not be good. That would definitely push us above 7, probably closer to 7.5. If I had to guess, we might get up to a new high over the last year. So we got to hope that data comes in our favor. We got to see what happens over the next couple of days. Hopefully that all goes well. And by the time I talk to you guys next week, I have good news to report as far as that inflation data and the Federal Reserve report. Have a great day, everybody. And if you need anything else, don't hesitate to reach out. Bye-bye.